A year-end review. That is the purpose of today's video. I want to go over the tumultuous 2024, the buys, the sells, and all the turbulence along the way. I like to see how I stack up against the S&P 500. So I will look at that as well as going over the types of returns I'm calculating. So without further ado, let's get right into the action. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Welcome to the Quality Investor. So how did the S&P 500 perform in 2024? Year to date, the index is at 6,040.04. It is up 27.35% on the year. It has been an incredible year for the S&P 500. At over 27%, it has surpassed 2023's total of just over 24%, assuming, of course, we don't lose a few percentage points here in the next couple days. So certainly a lofty benchmark to live up to in 2024. But before we get into that, I wanted to point out one thing. To me, it's always interesting what the analyst predictions are going into the next year. So for 2023, I want to take a quick look at what those analyst predictions were. Well, according to the JP Morgan Chase, it was at 4,200. Morgan Stanley was 4,500. Bank of America, 5,000. Goldman Sachs, 5,100. And Citigroup, also 5,100. And like this person says, friendly reminder that no one knows what the future holds. So any predictions that you see out there, I would always take with a grain of salt. So to that point, here are the predictions for 2025. UBS, 6,400. JP Morgan, 6,500. Goldman Sachs, Morgan Stanley, also 6,500. Barclays, RB Capital, 66. Bank of America, 6,666. BMO Capital at 6,700. Deutsche Bank and Yardeni Research at 7,000. And Wells Fargo at 7,007. So analysts are projecting anywhere from a 6% gain in 2025 all the way up to a 16% gain. We shall see what happens. But here we are at 60-40, but let's take a look at my portfolio. So here we are looking at the year of 2024, 1/1/2024 through Christmas Eve 2024, and I'm looking at just my active holdings. So this is sorted right now by my allocation percentage, Microsoft being my largest and Microchip Technology Incorporated being my smallest. I did sell some things during the year, which I'll show you in a second. But as for my largest holdings, all of them did very well in 2024. Microsoft, Alphabet, Visa, Apple, and Tesla, the real surprise, especially over the last few months, really helped push my portfolio forward. The total return here for Microsoft was at 26%, Google is nearly 30%, Visa at 28.5%, Apple at an amazing 44.8%, and Tesla blew everyone out of the way in my portfolio at 124% return year to date. As you can see here, we have a total return, a time-weighted return, and a money-weighted return, which is annualized. The total return is simply taking the market value of my portfolio today over its cost basis. It doesn't account for any timing or cash flows. My worst performing stock on that basis has been Microchip Technology Incorporated, sitting at a negative 27.9%. It has certainly been painful to watch this stock, especially in the last couple months. If I click on it there, I can see what it has done on my return here for the year. It was doing pretty well for me in May, and then since then has just been in a free-for-all. A lot of this has been sort of expected in terms of the earnings, but I think the market impact has been a little bit more than I was anticipating, especially since they had some pretty suspect earnings in which the market didn't get too affected by it. And you can see this time-weighted return here on a monthly basis was doing pretty well there early in the year and just month after month of bad returns. So far December has been down 14% on a time-weighted basis. I still believe my thesis intact. I've had stocks that were performing worse that have turned it around though. And the general portfolio value of the stock has just steadily decreased. And that is why it's down so much as an allocation percent here. It has simply lost a lot of its value. Tesla, on the other hand, has been a completely different story. When 2024 began, Tesla ended January at 2.3% of my total portfolio, and the the share price at the end of January was $187.29. And it didn't get better through the first half of 2024. You can see closing below 200 in nearly every single month until July. But Tesla started making a bit of a comeback in July. You can see the big pop here after that Q2 earnings. And its big bump really happened post-election. For some obvious reasons, Elon Musk is, of course, very close to the new administration with Donald Trump. But man, has this stock gone on a run. And it is now 6.76% of my portfolio. I do not see this price lasting that much longer. However, I definitely view Tesla as a very long-term hold. I have no plans to sell, despite the very nice profit I have made so far if I would be selling. And you can see just that market value in general, my portfolio has climbed significantly. I'm not showing the actual value of my portfolios. I'm just not comfortable to doing that. But you can rest assured that these returns are very accurate. Any sleuths out there can certainly deduce my cost basis in all of these, looking at the total return versus what the share price is. The share price is as of Christmas Eve. I have two other types of returns in here: time-weighted return and money-weighted return. Time-weighted return are rates of return that do not take into account the impact of cash flows in and out of the portfolio. Money-weighted returns are rates of return that do take into account the impact of cash flows in and out of the portfolio. So that's the basic difference. Time-weighted return is defined as a compounded growth rate of $1 over the period being measured. The time-weighted formula is essentially a geometric mean of a number of holding period returns that are linked together or compounded over time, thus time-weighted. Depending on the total time period that you're calculating a return for, you can break it down to a subunit of a month, a week, or, as I am, per the day. The money-weighted return, however, it calculates the investment performance taking into account both the size and timing of cash flows in and out of an investment portfolio, placing a greater weight on periods when the portfolio size is largest. So what is the more appropriate method to use here? So time-weighted return, because it removes the impacts of the cash flows, it makes it ideal for calculating the performance of a broad market indices or the impact of a fund manager on the performance of an investment. Time-weighted is important in this context as fund managers do not control the timing of cash flows in and out of their fund. However, for a vast majority of investors, a money-weighted rate of return is the most appropriate method of measuring the performance of your portfolio as you, the investor, control inflows and outflows of the investment portfolio. So I calculate both, but I am biased towards the money-weighted, as you'll see why in a second. But from a calculation standpoint, time-weighted, like I said, it's a geometric mean. I'm taking that geometric mean of all these daily performances of your stock portfolio. Money weighted is basically the IRR. It's an internal rate of return calculation. So back to my returns here. The time weighted return of this portfolio is 20.96%, and the money weighted return is at 28.83%. So of course, I'm going to boast about the money weighted return that I achieved this year. It beat the S&P 500 by about 1.5% so far. But at the end of the day, I do think the time weighted return is an important thing to consider. However, I do think it's important to account for the cash flows. Cash flows in or sales really do affect the portfolio. However, when I look at the stocks that I sold this year, you can see my money weighted return is not as good. It's at negative 3%, whereas my time-weighted return, on the other hand, is at 25%. And the big culprit of this one is Pfizer. I sold it at the very beginning of February. I essentially had cut my losses at that point. I was down nearly 30%, and I said, it's just time to get out of this. And it killed me on a money-weighted basis. You can see here, 56% on a money-weighted return basis of loss. Others that are interesting are Photronics. I sold Photronics at the beginning of December because I was actually going to be buying Airbnb. So I needed capital to help do that. And Photronics had a great earnings report at the end of November, and it shot the stock up, giving me a nice little return here. So my total return on Photronics was at 10%. It was kind of languishing throughout the year. And I was negative for a while before finally getting back in after that earnings report. But the time-weighted and money-weighted returns don't lie. Just because I was able to sell Photronics at a profit based on the cost basis alone, it was a very small profit, and just my buys and sells throughout its history just made it a not very good investment for me. I sold Lowe's earlier in the year as well. That was also to create some capital. I was doing well in my investment as the total return, time weighted, and money return all show here. So I sold Lowe's at a very nice profit. For McDonald's and Coca-Cola, I sold for basically the same reasons. I sort of fell in love with them early on in my investment endeavor, but kind of realized over time that they're not that great when it comes to growth. So I cut my losses, small gains, and sold out of those. And Realty Income I bought because of its dividends. And what worried me about Realty Income ultimately was that a very large part of their real estate portfolio is made up of Walgreens. And Walgreens is in deep financial trouble right now. And they're closing stores left and right. And to me, that made Realty Income become a little less steady, a little less predictable. So it was time to let it go. I also added a little bit to stocks I currently own as well throughout 2024. A good example is MSCI. I think this is a good example when it comes to loading up when the stock is beaten down. You can see my total return on this particular stock started trending downward in early 2024 before bottoming out in April 2024. But if you look at the portfolio market value here, you can see it jumps up quite a bit throughout May. That's because I spent May buying a lot of MSCI. I felt at the market prices it was trading at that I was being undervalued by the market, and I took that opportunity. Even though it was down in my portfolio, I was negative at that time, down to almost 10%. I started buying a lot more MSCI. And to me, it's paid off. You can see it climbing the rest of 2024. That just demonstrates the importance of not letting fear get in the way of your investing plan. This also shows the difference between time-weighted and money-weighted, in my opinion. My total return in 2024 is at 23.6% for MSCI. My time-weighted is at 6.25%, and my money-weighted is at 24.4%. Remember, time-weighted removes the effects of cash flow, but I was loading up in May in MSCI. So I was buying a significant amount of MSCI when it's down very low in the portfolio. So from here, I had a much better return throughout the rest of 2024. Removing the timing of those cash flows, MSCI reflects that, but including this impact of that cash flows, really the cash flows into the stock, is reflected here in the money-weighted return. United Health and Adobe are both investments I would like to see doing a little bit better. I honestly don't understand why they're not doing a little bit better given their earnings power and cash flow. Well, I do understand why, but hopefully the market sees it soon. But all in all, I'm excited for where my portfolio stands right now, heading into 2025. I think there's a lot of growth potential here from each of these businesses, and I'm looking forward to hearing everybody's thoughts on this portfolio update for 2024. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.